Perfect. Thank you so much. Now that we're past our kind of basic definitions, we're going to get into some actual building blocks, because this is where it's going to start coming together and making sense. And I know that first bit may not have yet, but it will. If we look at some basics, we said, okay, I kind of got the real raw idea. It's 20% of our business income. That's our deduction, right? When we look at it, that really is still huge. Let's say that qualified business income is $200,000. Your potential QBI deduction, $40,000. Well, consider a marginal rate of just 24%. Gosh, that's actual dollars, like savings, $9,600 in savings. So yes, this is a big deal, and that's why we're all very interested in this. It's generally available to owners of those pass-through businesses we talked about, those RPEs. It's limited, however, by that business owner's total taxable income. And it's also limited potentially for specified service businesses. So that's what our limitations are. Income-based and what type of a business it is for the most part. So if we look at some real basics of this, again, I mentioned that publication 535. They also, within the actual 1040 form instructions, talk about what to do about line 9. So if you're doing some tax programs have it looking similar, some of them do it on the side, but we have a worksheet that helps us to figure out what goes on line 9. Each business is listed separately, and then the total qualified business income is combined. Income and loss, by the way, so losses get subtracted and income is added. And this is used if they're below the threshold, and we'll talk about what that threshold is. So if somebody's below that income threshold, they can use this simple worksheet. And if they're over, we got to use a different one, and we'll talk about where that under and over is. So that's one of the main things to pay attention to, is the total taxable income. For most of our taxpayers, it's not an issue. It's actually, one of the estimates is thinking that 97% of most of the individual taxpayers are not going to worry about being over that threshold and having to do anything fancy. However, that's not everybody. If you're over those dollar amounts, you're going to need to do something called wage and capital testing. So we're going to talk about that. The threshold amounts, and this is going to be subject to cost of living annual adjustments. I'm giving you the 2018 amount because we're still kind of dealing with 2018 tax returns here, but know that it is different for 2019. So the threshold amounts, this is taxable income. So you prepare the whole entire return all the way through, all the way to the point you get to taxable income. And then we use that to worry about this qualified business income deduction. If you're single, that threshold amount to stay under, where we have no worry, and over, we got some more stuff to do, $157,500. Married, it's basically that times 2. $315,000 is that threshold amount that we have to start doing additional calculations. For estates or trusts or children subject to kiddie tax, basically everything and everybody is $157,500 except married. It's that for 2 people. This is a chart that I've created just to kind of help simplify, and this is going to be included in your slide deck. I'm kind of putting that out there not to overwhelm you yet, and you won't be once you understand what these mean. But the first test is that taxable income amount. If we look at a single filer or a married filing joint filer, and we just say, okay, is their income, we've done the whole return, is it less than that amount? So married filing joint, let's say their total income is $200,000. We say yes. Okay, cool. 20% QBI deductions available. We don't have to worry about all this other stuff unless they're over those amounts. So that's the main takeaway. I'm going to help you to understand what all these calculations are, but you don't have to panic, because for the majority of our taxpayers, it probably isn't going to come into play. Another way of looking at it. Now, if we talk about limitations, we have to say, okay, our married filing joint, if we're less than that $315,000, remember, it doesn't matter what kind of business you are, 20% deduction. For our single filers, less than 157.5, 20% deduction. It's the over amounts we have to worry about, and this is why we say the type of business begins to matter. If you're over, this is kind of like the in-between. If you're over the highest point of that income threshold, $415,000 for married filing joint, and you're a specified service trader business, plain and simple, there is no deduction. If you are not in that category, you have to do some additional math called wage and capital testing. So these are the thresholds. You'll be able to refer back to this later, but I just kind of wanted to put that out there initially so you just get acquainted with some of that. The takeaways here are managing the amount of taxable income. And we have to watch the wage and capital limitations for those non-specified service businesses if that individual has higher income. So I'm going to just give you an example. Let's say you have a specified service business. Married chiropractor, they earn $450,000 married filing joint taxable income per year. That was over that $415,000 mark. Well, because they're a specified service business and they're over that limit, very simple calculation, it's zero. You get no QBI deduction. However, somebody else, also married, works in that same company, earns $300,000. That's under that lowest threshold, so they get the full QBI deduction. I mean, that is a very big difference if you're not managing that. So one person gets $63,000 deduction, the other person gets zero. So the takeaway is, and that's just a very big number difference to show you how it works out in the end, it's managing taxable income that becomes important. So if you say, what could you do? It's going to come down to how do you manage that income? The general limitation. Now, this QBI deduction, they throw one little wrinkle in there. So even our 20% that seems easy, and we said, oh, yay, we're under the income limit, this is an easy calculation. They say, oh, hold on a second. We're going to still limit it potentially if your combined QBI amount, and this is the official definition. I'm going to try to break it down a little bit easier for you, basically. So we look at all of our total combined QBI for all of our businesses, because maybe you have more than one. And then we add in 20% of our real estate income. That's actually investment trust, sorry. Publicly traded partnership, you add the 20% of all those together. We come up with our potential QBI amount. And then we say, okay, here's our one bucket we filled up, and this is how much deduction we want. But how much do we get? And they'll say, here's how you know how much you get. Look at your total income, take out any, capital gain portion of it that may be affecting it, capital losses. So here's some numbers. This is going to make this a little bit easier. What if your QBI, your business income, is $250,000? And we've done all this first calculation. This is the bucket of how much we want to take. 20% of that, $50,000. We want to take $50,000. And they say, okay, wait, your taxable income, though, is only $200,000 because maybe you had a capital loss. You take 20% of your total income, and it's only a $40,000 potential QBI deduction. That's what they're going to give you as the lower number. So all that complicated stuff up above is just a matter of comparing your potential QBI deduction to 20% of your business income, because if they have losses that maybe reduce your income to nothing, they're going to say, hold on a second, we're not going to let you take this deduction. So our general limitation is what affects that. In the final regs, they also told us that we have to worry about our income being reduced by a couple other things. Now, this is going to affect more like our sole proprietors, but they said you got to take out half of your self-employment tax because you got some benefit from that deduction, your deduction for your self-employed health insurance, and you're going to deduct out certain qualified plan contributions, which like your SEP plans or the self-employed plans, but interestingly enough, it doesn't seem that the IRAs are maybe affected in the same ways. But here's what we have to worry about is if you were using the final regulations to prepare your return, your tax software, and you should be watching that these get deducted as well. If you're especially dealing with like your Schedule Cs, you're going to see this appear a lot more often, but the same thing for partnerships if you carry that income through. So watch that this is a little bit of a change compared to where we were before. So if you're choosing not to do this for 2018 and you're only using proposed regulations, then you need to check your calculations and make sure and see if you have to override that. Another example of kind of our general limitation, I'm going to give you some numbers that you can work out in your worksheets because that's the best way to practice and to really understand this. Yeah, software can do that for us, but if we don't understand the basics, it's kind of hard to understand what's really going on. So if we look at what if our income is more than our business income, our combined QBI. So in your supplemental materials, you're going to find some worksheets. Worksheet 1 is where you can actually do this calculation. This slide is, all the slides are the answers. So it's like the answer key I'm giving you here. So we're going to talk about Larry, lawyer. Now we know he's a specified service trader business. I'm going to give you that up front because I know you haven't maybe taken that course yet. He's married, he's a lawyer, specified service trader business. He has 100,000 of QBI income, and his total married filing joint taxable income is 200,000. So how do we go about this? If you actually work out in the calculation, what you will achieve is we have to figure out what that tentative or potential QBI deduction is. That's where we take the QBI income 100,000 times 20%. We get $20,000. Try to make easy numbers for us here. And then we have to say, oh, but just in case, let's make sure that we're not being limited. So our taxable income, we multiply by 20%. It's 40. Oh, easy. We get to take the full amount of QBI because we have more available. So that's a relatively easy test. It doesn't mean that it's going to be limited. We just have to check and make sure it isn't. So we get a full. The answer to this one for worksheet 1 is $20,000. But then as we look at what happens if that taxable income is less than our QBI. So this is going to be an example you can work out on worksheet 2. Same guy, Larry Lawyer. He's married still. Now he has 300,000 of QBI income, but his married filing joint taxable income is 250,000. So we don't know what kind of loss. Something happened in there. It reduced his total income. What we'll do is say, oh, awesome. We can potentially get a $60,000 deduction, 20% of 300,000, right? But hold on, we got to look and say, let's just not make sure this is going to get limited. Let's take 20% of our taxable income. That's only $50,000. Then they're going to say, well, you get the lower number. It's going to be limited by that taxable income number. So you get $50,000. That's a lot of numbers I know that I threw at you, but we're going to keep running through some examples and some more math because I know that's going to help bring it to home. But the main point too is that I gave you worksheets so you can just kind of play with it. I've got a lot of great feedback that just working through the worksheets, and I can tell you designing them really helped me to understand this crazy math that goes in.